What if I told you that investing in the US stock market could be one of the smartest financial decisions you ever make? It is not just for Wall Street professionals, it is for anyone ready to take control of their financial future. In this video, I will guide you through everything you need to know to get started with the US stock, from the basics to strategies for beginners. Stick around until the end and I will share you a key resource that helped me simplify complex investing terms and build a strong foundation for smart investing. Warning: this video might make you want to invest in stocks immediately. Side effects may include financial growth, increased confidence, and a sudden interest in company earnings report. Don't forget to like, share, comment, and subscribe to the channel. Your support means a lot to me and motivates me to continue creating more valuable content. Now let's get started. Why US stocks matter? Firstly, because it is a global market leader. The US stock market is home to some of the world's largest and most influential companies like Apple, Amazon, and Tesla. These companies are driving innovation around the globe, and by investing in them, you are getting a chance to tap into that growth. Second, proven long-term growth. Historically, the US stock market has delivered strong returns compared to other types of investment. For example, the S&P 500, which tracks the 500 largest US companies, has averaged about 10% return over the long run. Adjusted for inflation, that's still a solid 7 to 6% return annually, helping many investors build significant wealth over time. Third, deep and liquid market. One of the key benefits of the US stock market is its liquidity, meaning it is easy to buy and sell stocks quickly and at fair prices. That helps keep prices stable and reduces the chance of major swing, making it more efficient overall. Bottom line is, the US stock market isn't just another investment option. It is a powerful tool to grow your wealth over time. If you're looking to build long-term financial growth, this is a great place to start. Now let's talk about the different ways you can invest in the US stock market. First, individual stocks. The process investing in individual stocks like Apple and Tesla give you the chance for big rewards if the company does well. It is exciting because you are betting on the success of the company you believe in. The downside is riskier. The value of your investment depends on how well that company performs. Plus, you will need to do your homework, constantly researching and keeping up with the company news and performance. Second, mutual funds. The pros is that mutual funds are managed by professionals who choose the stocks for you. They also let you invest in a mix of companies all at once, spreading out your risk. Think of it like putting your eggs in several baskets instead of just one. However, mutual funds comes with higher fees because they are actively managed. Also, you cannot buy or sell them as easily as individual stocks or ETF. You can only trade them once a day after the market close. Personally, I have moved away from mutual funds because of the high fee and switched to ETF, which offer a low-cost passive investment options, something I will explain next. ETF stands for Exchange Traded Funds. The pros is that ETFs are a great choice for beginners. They have low fees and you can buy or sell them anytime during market hours, just like individual stocks. They are also very well diversified, meaning spread your investment across many companies, which reduce risk. For example, the SPDR S&P 500 ETF SPY give you an exposure to 500 of the largest US companies. While ETFs are easy to use and cost-effective, they tend to follow index like the S&P 500, Dow Jones, or Nasdaq, rather than being actively managed, which means you don't have someone picking the stock for you. If you are just starting out, ETF can be an easy and low-risk way to begin investing. They offer diversification, so you are not betting on just one company and you don't need to dive into the complexity or researching individual stocks. Let's talk strategy. How do you invest wisely? First, start small. The key is to start with an amount you are comfortable with. Even if it's just $100 a month, you are setting yourself up for success in the long term. In fact, if you invested $100 every month for 30 years with an average annual return of the S&P 500 around 10%, you could end up with approximately $200,000, even without increasing your investment over time. That's the power of compounding. Your money works for you as it grows. Second, dollar cost averaging. This is the strategy of investing a fixed amount regularly, say $100 each month, regardless of the market's up or down. The beauty of this is that you buy more shares when prices are down. This will smooth out the volatility. Take a real-life example. If you invested $100 every month in the S&P over last 20 years, let's say, you would have outperformed many stock pickers who try to time the market. Regular contribution, even when the market drops, could still have built significant wealth, proving that consistent, steady investing often beats trying to pick the perfect stock at the perfect times. Third, long-term perspective. Remember, stocks can fluctuate in the short terms, but staying invested over long terms is where you will see the magic of compounding. Even during periods of market turbulence, like 2008 financial crisis and 2020 COVID-19 crash, the market eventually rebounded and continued to grow. In 2020, the S&P 500 dropped by more than 30%, but by the end of that year, it had rebounded and posting a return of over 18%. Those who stay invested saw their portfolio recover and grow, while those who panic and sold missed out the rebound. Fourth, avoid panic selling. It's tempting to sell when seeing the market dips, but doing so locks in your losses. Market corrections are a natural part of investing. The key is to stay focused on your long-term goals. After every major market sell-off, there has been a recovery. In 2008, and even in the recent mini crash happened in August 2024, where the market dropped by 6% within 2 weeks, and quickly recover afterwards and even achieve all-time high afterwards. Remember, investing is a marathon, not a sprint. So what about taxes when investing in the US market? Let's break it down because taxes can get a little tricky when we are talking about international investment. So, the US typically withhold a 30% tax on dividend, but this is usually deducted at the source, meaning you receive your dividend net of the tax. There is no federal tax on capital gains for non-resident aliens, which generally include Singapore residents. Additionally, Singapore does not tax capital gains. Making profits from selling US stock is completely tax-free. However, it is important to be aware of the US estate tax. This tax applies on the value of your assets, including US stocks and ETF, upon your death. The exemption for non-residents is currently only $60,000 USD, and estate tax rate can range from 18 to 40% on assets exceeding this exemption amount. It is advisable to explore estate planning strategies to minimize potential estate tax liabilities. A key resource to simplify complex investing terms is Investopedia. It offers a wealth of educational content tailored to beginners, covering everything from the basics of investing to advanced strategies. They also have articles, tutorials, and a dictionary of financial terms, which can help you better understand key concepts and avoid common mistakes. Additionally, you can take advantage of their stock simulators to practice investing without risking real money. Using tools like these will build your knowledge and confidence, helping you to make informed decisions rather than jumping in blindly. And that's your practical guide to US stock investing for beginners. Remember, investing isn't about timing the market, it is about the time in the market. If you found this video helpful, hit the like button and subscribe to the channel for more tips. Have questions? Drop them in the comment below. I would love to help. Thank you for watching, and here's to your investing journey. See you!